Why don't we go ahead and get started? I see some attendees are still kind of joining, but in the interest of time, let's go ahead. So good afternoon, everybody. My name is Leslie Ramiza. I'm the program manager of the Cutler Center for Investments in Finance. We're pleased to have everyone join us for today's Finance Friday webinar, Navigating the Real Estate Markets, Insights from an Entrepreneurial and Family Office Perspective. Today, we welcome Professor Erin Degnan Escobedo and Stephen Congel. I want to take just a minute to introduce both Erin and Stephen. Erin is a full-time lecturer in the Finance Division and the George E. Sly Term Chair in Real Estate Management here at Babson. She teaches courses in real estate finance, investment, transactions, development, and residential real estate, as well as business law. Since joining Babson in 2017, she's developed 5 new real estate courses for the undergrad and graduate programs, helping to double the real estate course offerings for Babson students. As a licensed attorney in Massachusetts and Florida, Erin has practiced law since 2004, focusing her practice primarily in real estate transactions and development, including representing the nation's largest home builder as part of its state council team for all of its Florida projects, and also serving as associate general counsel to a NASDAQ-listed property developer. She's also a licensed real estate broker in Massachusetts. Stephen is the Chief Executive Officer of Pyramid Management Group. Headquartered in Syracuse, New York, Pyramid's portfolio of retail-based tourist and entertainment destinations dominate the Northeast, with 16 properties located throughout New York and Massachusetts. Pyramid was founded by Stephen's father, Robert Congel, in 1970, and Stephen assumed the role of CEO in June 2008. Prior to that, he held the role of Managing Director of Nettleton Global, which is an international real estate planning and feasibility company based in Singapore. And concurrent to this role with Nettleton Global, Stephen also served as a partner of Destiny USA, which is Pyramid's flagship international tourism destination in Syracuse. In his over 30-year tenure at Pyramid, he has served in various roles in operations, leasing, development, and international business development before assuming the role of CEO. He's an industry thought leader and has been featured on Fox News, CNN, The Wall Street Journal, Forbes, CNBC, and others. And he is also a Babson alum. In today's session, Erin and Steve will discuss Steve's entrepreneurial journey in real estate. He will be sharing his insights and perspectives on navigating the real estate markets, including leading Pyramid through the global financial crisis and the COVID-19 pandemic, as well as discussing the opportunities and challenges in real estate today. We welcome all participants to ask questions throughout their conversation. You can use the chat feature to submit your questions, and we'll also be recording today's session, which will be available on the Cutler Center website afterwards. So with that, we are excited to have you both here with us today. So thank you, Erin and Steve, for being here. I will turn it over to both of you to get the discussion started.
Thank you, Leslie. Thank you so much, Steve, also for being here today, taking time out of your very busy schedule to join us and to share your insights. So, you know, we've heard about your tremendous background and expertise in real estate over the last 30 years, and we're going to touch on different aspects of that career path. But to get things started, I'd like to open it up with a question in terms of, you know, how did you find your passion in real estate? Was it really from growing up in the family enterprise and the family business? Could you just share your thoughts on that?
Sure. Yeah, I do think it is from growing up in the family business. You know, my father started off as a contractor in the 1950s after he graduated from college. He was following in his father's footsteps, who was following his grandfather's footsteps, Italian immigrants. So there's a long lineage of construction and development in our history. And by the time that I was old enough to have an appreciation for what my dad did for a career, you know, he was pretty much exclusively in development and out of construction at that point. And all I ever really wanted to do was go to work for my father. I'm the youngest of 5. I have 2 older brothers, 2 older sisters, and everybody's been in the family business at various times. I'm the only one who still is, but all I ever really wanted to do was work for my dad.
Excellent. So thinking about a little further, talking about the time you graduated from Babson in for the degree in entrepreneurship in 1991. Was there, you spent some time in the industry, learning from ground up in a shopping center, exploring different roles along the way, operations, leasing, development, as well as international business development. What are some of the unique challenges and opportunities that, working in a family enterprise present?
Well, when you work in a family enterprise, it's great and it's terrible. And there's not a lot in between. And that was something that I remember when I first started at Babson. I took several family business classes and learned how to navigate. And they brought in great speakers, typically fathers, sons, father, daughters in businesses. And you learn a lot from hearing how other people navigate it. And I guess the most important thing that I learned from my time at Babson and my experience there is that everybody goes through these challenges. You don't have to feel like, oh my God, our family's such a mess and we're unique in not a good way. Family businesses navigate these challenges. My own personal experience, there were really very few challenges with my father. We had a great working relationship. We worked very, very well together. We had a very simple policy, especially when I became CEO and he was still active in the company. Our policy was we never disagreed when a third person was in the room. We just never disagreed in front of anybody, and we learned how to read each other's body language, and we would just stop meetings, and we disagreed a lot. I mean, we disagreed a lot. We just knew it was bad for the company to disagree in front of other people. And we would talk, and it wasn't always his way or my way, not at all. We would really listen to each other, and we would emerge with what our consensus was in the direction. It was very easy for me to do that with my father. Much harder with siblings. And again, I'm the youngest of 5. So with older brothers and older sisters, it's been more challenging. But, in terms of, our business, it was big enough where we could do different things, take on different duties within the company, and therefore separate ourselves a little bit. But, navigating the personal relationships with siblings is very, very difficult because, human emotions are human emotions, and there's no avoiding it.
So, thinking along the timeline, at this point, you graduate in 92, and you have been working for the company in all these different roles, navigating dynamics, helping with the leadership, and getting to the point in time where now it's about February 2006. And you found this international real estate planning and feasibility company, Nettleton Global, based in Singapore, clients in China, Emirates, Oman, India, Malaysia, Vietnam. Tell us what led you from being very successful and working to build and further the family enterprise to pursuing your own entrepreneurial venture, and particularly in the real estate markets in Asia and the Middle East.
Sure. Well, my time, my experience with Nettleton, at least starting it off and launching it, I'll describe as all passion, no experience. I just, first of all, at that point, I had spent 14 years in the family business, and at least both my brothers were still involved in the business, and they had more senior roles than I in the business. And candidly, I saw a glass ceiling for myself at the company. That, combined with not wanting to be in the family business any longer, combined with having a huge desire to get involved in the emerging markets of Asia and the Middle East, and just candidly just be part of it. And I've always had a strong desire to explore and travel and learn about different cultures, and that's why I really pursued Nettleton Global and launched it. When I left the company, when I left the family business, I didn't immediately jump in. I took some time to reflect and get to know my own family a little bit, and then reaching out to people I had relationships with, formulated the idea of putting this company together based in Singapore. And Singapore was just a very solid place to do business in terms of the banking and judicial systems, and very solid, safe, and secure. We actually did very little business in Singapore itself, mostly surrounding in Southeast Asia and China, India, and Middle East. But I was just a passion to take what I knew in real estate and a passion to explore these emerging markets and figure out what did I have to offer. And that's how we came up with a company where we would often advise clients who typically had family businesses or very big corporations, typically based in manufacturing. So they had a great deal of wealth. They typically owned a great deal of land. They had very strong political connections, but they wanted to do big real estate development. So we would come in just at a very high level and do high level planning and feasibility. And then it would either get accepted or rejected. And then if accepted, we would help turn it over to the actual master planners and capital partners. So it was a great experience learning how to do business in different countries and different cultures. It was a fascinating experience, as well as learning how to run a business on my own and have nobody, to fall back on other than yourself. And that's really where I did dig deep into my experience at Babson and being an entrepreneurship major and having to write business plans. And I will admit, I dug a lot of that stuff out, 15 years after graduating, to say, wow, I need this knowledge, and was very happy to feel like, my time at Babson was, it was important in my growth and my learning.
Thank you for sharing that. And it's always great to hear that, you had that practical exposure and you were able to apply what you've learned in your classes, but also draw from your years in the family business. If you compare, there's lots of comparisons that we can make between real estate markets in the United States and real estate markets overseas. Two questions. What did you find that how did your experience at Nettleton working in these different markets, how did that help or influence, shape your career coming back to the US when you finally returned to Pyramid? And the timing of that is 2008. I think you previously said June or so, 2008.
That's right.
So how did your time and experiences at Nettleton shape your career? And were you able to find similarities and that between the markets that helped position Pyramid to weather the storm in the Great Recession?
Well, first of all, I think if I hadn't left the company and gone and started Nettleton based in Singapore, I probably would never have been offered the opportunity to come back as CEO. In the time that I had left and started Nettleton Global, both my brothers had left the company. My father was not acting as CEO. At the time, he was focused on just one candidly a pet project of his here in Syracuse, and the company was really being run by a board at the time. I had tried to introduce some of my international relationships to Pyramid during my tenure at Nettleton, and I think because of that, a conversation was started that I had never thought would ever be initiated after I left. I really never thought I would ever come back. But I think because of what I had done and because of some of the exchanges we had with my relationships, I was offered the post of CEO early in 2008. And my initial response was, thanks, but no thanks. I was in the family business. I really don't want to come back because, again, it's good and it's bad. And I was thinking of some of the bad experiences at the time. But after thinking about it over several months, I said, I really think I could take some of the experiences and knowledge I gained from Nettleton Global in Asia and seeing how some really cutting edge real estate developments were unfolding in different parts of the world and translate that to real estate development in the US. And candidly, my opinion then and it is today that other parts of the world are far more advanced with the type of real estate development that we do, mixed use with obviously a concentration in retail, but with a heavy influence of entertainment, recreation, food and beverage, hospitality. in a scale where these projects really act as tourism destinations, I really think that there's some really cool and interesting things being done in other parts of the world. What my opinion of what's being done here in the United States, especially with the enclosed mall industry, which is our specialty, it's a little bit too cookie cutter, and it needed some creativity. And I think because of that, I brought some of those ideas as well as relationships. We really started to recruit much heavier for international retailers to come into our properties in the US. And we were successful bringing some over from Europe and the Middle East.
Thank you. So, you know, Pyramid was an early leader in creating experiential retail and creating these entertainment type retail uses within the shopping center experience. And I want to kind of elaborate on that and go a little deeper with that as our conversation progresses. And would you say that that was a main contribution that you, under your leadership, the growth of the company in that direction? If you're coming back to the US, early 2008, you've learned about, all of these different types of, entertainment, tourism, uses in the shopping center and the retail spaces. Was that something that was already in place in Pyramid's portfolio at the time, or is that something that you really took the reins and were able to really integral? And I think I know the answer to that, but would love to hear that path.
Well, yeah, and I have to give a lot of credit to my father. He was always a forward thinker and out of the box thinker, and hated to do anything that had already been done before. It was just not in his nature. And so his strategy of development of enclosed malls was, regardless of what type of competition is in a market, if you're able to identify the most critical aspect of real estate, being a great location, that you could go in and build a property that would outcompete any of the existing centers that were there. And that ended up being true. Most of the markets where we built, there were 2, 3, 4, 5, even 6 existing enclosed malls in some of these markets. At the time, that was the norm. But he always liked to build at the best location, no matter how challenging that was, and build outsize the market. And because of the second factor, building outside the market, we're always looking for creative uses to put into our properties. So we were very early adopters of putting, things that are mainstays today, but were pretty cutting edge at the time, putting food courts in malls, putting cinemas in malls, and that transitioning, putting category killer tenants and big box tenants like, Target and Best Buy and Borders Books and some that have come and gone already. But, that was pretty cutting edge at the time. And that mentality continued. And I think all I did was pick up where he left off and bring the international influence and experiences that I had gained to that mindset and that culture here at the company. Unfortunately, my timing wasn't so great coming back in June of 2008, because the honeymoon lasted about 30 days. And then the financial crisis really, just totally crippled everything in our industry. So we had to switch gears. We had big aspirations of making a lot of changes. And then it went from, creative thinking and exploring new ideas to survival.
That's a great transition to dive a little bit deeper into the conditions of the Great Recession. What were the capital market conditions like in particular at that time? In 2008, the housing markets have collapsed. That we're in the middle of the subprime mortgage crisis. Foreclosures are rising. There's widespread ripple effects. What were the challenges you encountered in particular with the capital market conditions? We know that there was a liquidity in the markets at the time. Can you elaborate on sort of how Pyramid was positioned? And some of the strategies that you implemented and how that led you into on the right path to a recovery from that cycle.
Sure. Well, in the fall of 2008 is really when the financial crisis had the heaviest impact on our industry. We had a number of loans coming due, and most of our loans are in the commercial mortgage-backed security marketplace. So they're sold as tranched bonds off to investors after the initial financing. And these loans end up in big pools that are serviced by companies who didn't initiate or originate the loan. So they have these, pooling and servicing agreements that they need to abide by, which did not allow for these loans to be extended. The problem was the financial markets were closed, the loans were maturing, and nobody knew what to do. Nobody knew what to do. There was actually, no precedence for a period like this. And, we had all of our loans coming due. We had over $2 billion worth of loans coming due. And the biggest loan we could get from anybody was a $10 million loan. And that was only if we had posted a $10 million letter of credit. So, we couldn't get anything. So we spent a lot of time down in New York on Wall Street for the next year, meeting with these servicers and bondholders and saying, listen, nobody knows these markets better than us. We built these properties. We've operated in them for 10, 20, 30 years. If you want to get paid back, stick with us. And our request was simple. The interest rates were very low at the time, so there was very good cash flow coming out of the properties. And our pitch was keep the terms of the debt in place, give us all the cash flow that we need to run these assets, make sure that they're well maintained, and that we have every opportunity to capture every new leasing possibility that we have, including taking tenants from other competing properties at the time. And it worked out great because we had cash flow at a time when many of our peers did not, our competitors did not. So we were able to maintain occupancy at our properties. They were always well maintained, and because they produced a lot of cash flow at the time, we were actually able to pay down a lot of debt during the financial crisis, which put us in a great position coming out of the financial crisis, where the properties were very well leased, high levels of occupancy, high levels of net operating income and cash flow. And when the capital markets did return, we were able to, put a new debt, take out the matured debt and put new debt on our assets in a way where we could then continue our wave of reinvestment in our assets post-financial crisis. And we went through a period from 2012 to 16, where we basically remodeled every asset in our portfolio, which helped us weather the next crisis.
Thank you. Thank you for elaborating on that. And so the strategies that you implemented you mentioned something earlier that really had to do with your pitch to the lenders at the time was, we know these properties the best. And I think I would like to ask you about sort of how Pyramid is structured. So it's all in-house in terms of the asset management, the property management, the leasing, the development, really. So you are in a position where you know the assets best, you know the markets the best. And did you find that to be a competitive edge for you in that time period? And how, and thinking forward, what did you learn from how you managed that crisis, this storm, as we get into what's unfolding at the time period now with the COVID pandemic impacts on the markets, but also right before that, the retail apocalypse, which is really in that recovery period between the Great Recession and the COVID pandemic? Sure.
Well, yeah, I think our strength has been, our industry is dominated by very big public companies. It always has been, at least in the last 20 to 25 years. And we're a private company, which makes us unique in our specific sector of enclosed malls. And we're not nearly as big. So that has played out as an advantage right now, not being public and being smaller. It allows us to be very, very hands-on with every aspect of our business. Most of the senior team of our company has worked in operations, worked out in the field, worked in the properties. So not only do they know the business, they know the specific assets, they know the markets. And the lenders who we work with know this about our company. We do everything possible in-house, like you said, leasing, revenue administration, legal, development, construction. All of it is done in-house. And therefore, we can work very, very quickly. We don't rely on outside parties in the day-to-day operations of the company. We know our markets because we built these assets a long time ago. We know them very, very well. And today, because of the financial crisis and then the retail apocalypse and now into COVID, we're really the 900-pound gorilla in each of these markets. And people know that. So we'll continue to use the strength and reputation of our operating platform to carry us through this crisis that we're in right now.
Let's talk a little bit more about, we're definitely going to go into talking about 2020 in the last year, and also forward looking as we emerge from this pandemic with the mass rollout of vaccines. Where we see that, how far out through the fog can we see? But I want to talk a little bit with you about a little bit more into the retail apocalypse. So you mentioned earlier that Pyramid was an early adopter of bringing in these large big box stores, national chains. You mentioned one store, Borders, for example. So in this time period that's, in the industry known as the retail apocalypse, we're looking at roughly, 2010 up into 2019, we have the closure of thousands, some estimates are 12,000 plus, physical brick and mortar retail stores throughout the US. And when you lose an anchor tenant, right, taking up the largest square footage, that can be really challenging for developers, for shopping center owners, for investors. And so how has Pyramid weathered that storm? And if you take us back a little bit before COVID, no one could have predicted what happened with this pandemic. But in 2019, as we're seeing shifts in consumer preferences, the Amazon effect, can you share a little bit of your insight into how you manage that and how you were positioning and how you were thinking about investing in your assets as this trend is unfolding and as retail is going through a tougher time? Sure.
Well, I think by nature of how my father created the culture and strategy around our growth, the fact that we have always, for 30 years been looking for new and creative uses to put into our properties, because candidly, our properties were typically 30, 40, 50% bigger than our next closest competitor. So we were always exploring creative uses to put in. And our philosophy was put uses in that the consumer wants. And our industry has really been dictated to and controlled by, historically, traditional retail, specifically traditional department stores. They had this mindset that enclosed malls had to be this pure retail atmosphere and environment. We were never big believers in it. We always thought, let the consumers dictate who should be in these malls, not the retailers. And because of that mindset, we've been putting these uses in our properties for 25 years. And because of that knowledge and that experience, it carries through to today. We know how to do it. And we know how to do it because we certainly made our fair share of mistakes over the years. But there's a way to do it and there's a way not to do it. And we've brought these uses into our facilities in a way in which everybody benefits from it because they're big traffic generators. And what I'm saying is, you really want to put these uses in your properties where they are focused on people accessing from the interior. And especially in our climate, our geography here in New York and Massachusetts, winters are very cold. People don't like to be outside in the winter if they don't have to be. So putting these uses inside the mall versus putting them on out parcels or scabbing them onto the outside of the properties, which is much easier and much, much cheaper. Our attitude is it's not the right thing to do for the longevity of the asset. And I think it's also helped us, as the retail apocalypse hit, which nobody could predict, we were somewhat sheltered from the brunt trauma of that, because our properties had already mitigated some of the loss because we weren't 100% traditional retail. Many of our assets today run at 70 to 75% traditional retail, and the balance is all these other uses. So we weren't as set back by it. And in addition, I think our competitors in our markets took a much harder blow than we did, which has really left us in a position of really being the only game in town.
Are there any similarities or differences between or lessons that you learned in the last cycle that you were able to apply in the last year as the COVID-19 pandemic unfolded? As particular retail, hospitality sort of was hit the hardest. Retail is right there as well. Stay-at-home orders, store closures. And then in 2020 we have a continuation of anchor tenant and major retailers declaring bankruptcy: JCPenney, Neiman Marcus, Ascensia Retail Group, which is Ann Taylor and Loft, GNC, J. Crew. So what were the lessons that you were able to apply from having navigated a prior cycle?
Well, I'll be honest with you. I'm not sure any of us had many experiences that we could pull from to deal with the initial impact of COVID. The closures of our properties, completely unprecedented. And then when they could reopen, the type of restrictions and things that we had to go through, from CDC guidelines and sanitary and cleaning requirements. It was just, I don't think anybody's been through it. And so we were feeling our way just as everybody else was. And we were very frustrated too. A lot of the things that were handed down to us seemed to a bit arbitrary as compared to what the government was imposing on other types of commercial real estate. But we navigated it. We got through it. And to be honest with you, when we started to reopen and learn the requirements that all guests were going to have to wear masks, people were going to have to space themselves apart, that stores would have limited occupancy. It all went much smoother than we ever anticipated. There are very few problems with it all. I think people just accepted that this is what we're going to have to do, especially in New York and Massachusetts, that were it was an absolute. There was really no negotiating it. There's not a faction that really I'd push back on it. So it went a lot smoother than we had anticipated. But it was tough. It's a very significant impact on business. And we're starting to see things return. Traffic is starting to return. In terms of prior crises and what we've had to do to navigate prior crises as compared to this one, it's going to be the same, because right now probably our biggest hurdle is the I would say the lack of appetite from capital markets to invest either in debt or equity in enclosed retail real estate. Right now our sector has got an awful lot of media attention, which it deservedly so, because we've been hit hard, probably second only to hospitality. But we'll get through it. And our conversation is going to be the same today as it was back in 2008 through 10. If people want to get paid back, we have the best operating platform to return these centers to their pre-COVID health.
Let's go a little bit deeper on the capital market conditions. How have these historically low interest rates and what are some impacted the lending environment, impacted investments decisions that you're making, restructuring decisions that you're making with pyramids with debt?
Well, our business is very, very capital intensive. It's not for the faint of capital heart at all. And it's always that way. Good times are bad. Bad times, it's worse. Right now, what we're seeing is there's just a really holdback from the capital markets to reinvest in our sector, because they want to see how we recover. It's understandable. And another thing that our industry in general really suffers from is the fact that malls don't die. A lot of malls in this country need to die. And unfortunately, they just languish at almost near death, but nothing happens with them. And it creates a sort of cloud over our industry that, malls are a thing of the past. A lot of malls are things of the past, but a lot of malls in this country will survive and thrive because, our industry, everyone says, the internet is putting, traditional bricks and mortar out of business. It really isn't. It has created a significant need for consolidation in our industry and a reduction of the amount of bricks and mortar space per capita. we're overbuilt. We're overbuilt in our country. Look at how the US compares to every other developed country in the world. We're, 2 to 3 times what most countries have in terms of bricks and mortar leasable space per capita. So we need to cycle through that. But malls, I think, because they're so big, and probably more importantly, they have disparate ownership groups within them. Typically, department stores, when they were developed, the department store owned their own building. The developer only owned the main mall. So you may have 2, 3, 4, 5 different parties owning an enclosed mall. And because of that, it makes it almost impossible for that asset to be transitioned into a new life. And they just sit and languish. And there's hundreds of them out there that are just sitting and languishing that really need to be repurposed into something else. And, it's going to take a long time for that to happen. But I think, that's something our industry is suffering from. But, in terms of bricks and mortar being gone, it's not the case. It's really transitioning into a new life in a new form.
Let's talk a little bit more about repositioning and also kind of the lease negotiation, your leasing strategy over the last year. And we have the additional layer of the regulatory restrictions, eviction moratoriums, state and federal that were put into place and are continuing for different types of properties today, even as we speak. So have you seen over the time period tenants, asking for lease concessions, rent reductions? Have you had tenants going dark? And I know you've had some great articles out there about Pyramid actually repositioning assets, bringing in Amazon, for example. Amazon is, acquiring one of the fastest growing companies, acquiring vacant space all over the country, all different property types, particularly looking at malls, shopping malls. Can you talk a little bit about sort of what's going on in the leasing environment at Pyramid's portfolio and where you see some opportunities are for repositioning assets?
Sure. In terms of what our tenants looking for, yes to all of the above of the things that you mentioned. The world is supply and demand. And right now there's a glut of supply. So it works in favor of the tenants and the lease terms and conditions that they're demanding. But we'll work through that. And again, we I think because we have, the dominant asset in each of the markets that we operate, we're able to navigate that and get through it in a way where everything is acceptable. Is it desirable? No. But, that pendulum swings back and forth. In terms of, what we're doing to keep our malls full and, the Amazon effect, the Amazon effect is absolutely there and true. I mean, there's no denying it or hiding from it. But what we started to see long before COVID, really midway through the retail apocalypse, what we started to see is the retailers, and regardless of their background, whether they were digitally native or bricks and mortar native, the retailers who really embraced both platforms and put together now an omni-channeling presence to the consumer, buy online, pick up in the store, buy in the store, return online, mix thereof. You have to provide the consumer whatever they want. What the biggest impact of the internet on all retail, and not just bricks and mortar, but online, is the consumer is far more savvy than they were before the internet. They have much more exposure to options, to pricing, to shipping, to having this instant gratification demand. And retailers have to supply that to consumers to stay relevant, to stay in business. And those who don't do that are not going to stay in business. And the one thing COVID did, they took a lot of retailers out that were on their way out anyways. They just accelerated the process. But if you take a look at the retailers who are really thriving and surviving today, they're the ones who thrive on both platforms and have invested in it and excel at it. I mean, Amazon, they're taking space in our malls, and not for distribution centers, but for, direct to consumer retail outlets. And a lot of digitally native retailers, Warby Parker and others are, leasing space in bricks and mortar format. You have to be really good at both to survive in today's world. And that's what we're seeing. And we're embracing that. We're making adjustments to our physical plant, how we have to operate it, allow people for, curbside pickup and allowing retailers to use all stores as almost mini distribution centers, because that's really where it's going to. People will, you buy online, go to any company, you buy online, buy 4 or 5 things. It might come in 4 or 5 packages because it comes from 4 or 5 different retail stores. That is the model going forward.
Let's talk a little bit about how far through the fog you can see as it starts to lift in terms of continued trends. You're mentioning several, the curbside pickup and adapting to changes in consumer preferences. As we've had an increase in vaccine rollout in the country, I think, first quarter 2021. You mentioned earlier in our session that you've already seen foot traffic back on your properties, and your properties are, mixed use, many of them shopping center, but also hotel components. You have a multifamily property, you're building another. So can you talk a little bit about that increase in foot traffic? And do you think that will continue through the summer? And how far can you see for predictions in 2021 for the properties in your portfolio?
Sure. Let me just give my opinion on what COVID has done to our industry. I really don't think COVID has done anything to our industry. And again, when I say our industry, I talk very specifically about the enclosed mall format, because that's primarily what we do. Even though we're diversifying a lot with hospitality and residential, multifamily residential, we're still an enclosed mall developer. But I think all COVID did was accelerate a process that was already happening. And a lot of retailers who weren't adjusting and couldn't survive, were over leveraged, whatever the case may be, COVID took them out quicker. The consumer preference changes and habits, that was happening. COVID just accelerated it. So from my perspective, as tough as COVID has been, in the long run, from my industry's perspective, we're going to be okay, because we were already preparing to adjust for it even before it happened. We're prepared to continue with this trend and change. I do think that, humans are social by nature. People want to get out and do things. People don't want to live, in their basements on their computers for the rest of their lives, because that's what they've been forced to do during quarantine. At least most people. People want to get out and they want to do things. They want to go out to dinner. They want to go to the movies. They want to get out and walk and shop and be outdoors and do things. People are social by nature. So we track mall traffic through mobile phone data apps that we subscribe to, and we're seeing traffic generally today at about 80% of what traffic was pre-COVID. So albeit a 20% reduction, we're very encouraged by that, because we still have significant occupancy restrictions at restaurants. The entertainment and recreation venues just got the green light to open about 2 weeks ago and are just starting to reopen. The cinemas just got the green light to reopen. Many still are not open yet. And they're huge traffic generators within our properties. And I don't think they're going to start to generate traffic until the movie product returns. And for us, because of where we are and their proximity to the Canadian border and the fact that it's still closed, it's a huge factor at many of our properties. And we're still seeing 80% traffic levels of pre-COVID. To us, that's very, very encouraging. And we think as the vaccine rollout continues and the cases of COVID continue to decline, we'll see those traffic numbers really accelerate. Candidly, we're anticipating almost a big bump this fall in the beginning of 2022, and then maybe a little bit of a normalization thereafter.
That's wonderful positive news for a Friday. It's great to hear.
You got to be positive.
Yes.
You got to think you're going to get through it, or you won't.
Absolutely, and you have the spring emergence from COVID that we're going to have here, which is excellent with this vaccine rollout. And lots of articles, also a lot of press about that pent up demand. We saw record travel in the month of March and month of April, school breaks, and so most of the travel and in terms of the whole hospitality pieces, are you seeing that the sort of leisure travel versus business travel? Any insights there?
Sure. The business traveler, which is the majority of business in our two properties in Syracuse and Albany, New York, that really has not returned to pre-COVID levels, not even close. But what we are seeing in a higher percentage than normal is the leisure travel. And we started to see the leisure traveler return about 6 weeks ago. We started to see some real uptick in occupancy numbers. And again, we attribute it to, we query the hotel guests and why they're there. And a lot of it is just pent up desire to get outside and go do something. Families coming to the properties for the weekends, just to stay at the hotel and enjoy the restaurants and the shopping and just get out. We're seeing, at both of our properties, on the weekends, we're seeing occupancy numbers in the high 90s. Several Saturdays we've been sold out. Something that we didn't think was going to come back this quick, but it is a significant percentage of leisure traveler. Until the business traveler comes back, I don't think the hotels return to a normalized, stabilized operating level. Albeit we're on a good trajectory right now and feeling very good about it.
Let's take one more question before we go to, I know we have some questions in the chat. Where do you think the biggest opportunity is as you're looking forward, predicting into the return of foot traffic, making up that extra 20% back to pre-COVID levels, fall 2021 into 2022? Where's the opportunity that you see in the retail space? Is it certain different types of experiential retail, different types of entertainment? Is it more of the international retailers coming in? Where do you see some opportunities?
Well, it's interesting. Our industry has been presented with an opportunity that it really hasn't had in the last, call it 20 to 30 years. And it is a period of creativity. In the past, what we did within our properties was really heavily controlled by many of our constituents. I mentioned previously traditional department stores. They dictated a lot what went on in our sector, because without the traditional department store, you didn't have a mall. The traditional department store doesn't carry the importance that it used to, and I don't think that'll ever return. But we also had municipalities, we had lenders that also were very, they were not big risk takers. So, we always like to do new and creative things, and we're constantly trying to convince those constituents to let us do things. Today, because of what's happened, and I think because of the fact that our properties are surviving and are doing very, very well as compared to our competition, I think they've given us much more carte blanche than we've ever had in the past. If we present an idea of, hey, let's do this, let's do that with a property, the response more often than not is, if you guys think that's the right thing to do, let's do it. So we have this sort of newfound, of loosening of constraints on our creative thinking that we really candidly haven't experienced in the past. And I think the developers, the owners and managers of this real estate that go with that and do really creative things are going to be the ones that flourish. The one interesting thing to keep in mind about the enclosed mall real estate sector, the number one driver of traffic in our facilities today is still traditional retail. Without the traditional retail, you don't have a mall, and you need the traditional retail. And the thing to also keep in mind, the pool of traditional retailers is smaller than it's ever been. So you have to be good. You have to be good. You have to be competitive. You have to make sure they go into your property. But you still need a majority. You're still going to need 50, 60, 70% of traditional retail, whether it be a mall shop or a big box or a category killer. You're going to need that in your facility to survive, because they generate the most traffic and the most income.
Thank you, Steve. The discussion's been really insightful. We've covered a lot of ground talking about family enterprises, real estate entrepreneurship, navigating not just the COVID-19 pandemic, but also the last cycle, opportunities and challenges in the retail space. Really appreciate your time today. I want to hand the mic back to Leslie to take some questions from the chat.
Yeah, sounds good. Thank you both. We do have a couple of questions here. So Steve, if, as you think about your career and your role in the evolution of Pyramid, if you were to do it all over again, is there anything that you would do differently?
Again, I think a lot of where I am today, I attribute to two things. One is not to give Babson a plug, but I got to give Babson a plug because I'll confess, I had absolutely zero desire to go to college, and almost hid under my bed the day I had to go, because all I really wanted to do was go work for my father, and tried very, very hard to resist. I was offered a couple of options, and going to college was definitely the best choice my dad gave me. But my time at Babson really, I think, was very important to me. The one change I would make, when I did go start my own business, and get that experience and have that fear, Thursdays were the worst because those were the days you had to make payroll. And what I would have done was accelerated that time on my own and that experience that I gained much earlier in my career. I didn't go do that until after 14 years in the family business. I think if I had done that much earlier, it probably would have changed the outcome for me and where I am today. So that's probably the biggest change I would have made.
Great. And we talked a little bit about, we talked a lot about the different market cycles. And so we have a question here. What would you say is your biggest challenge navigating today's pandemic impacted real estate markets?
The fact that the capital markets, and again, whether it be debt and or equity, really don't have a desire to invest in our sector yet. I think they're all waiting on the sidelines to see, how we pull out of the impact of the pandemic. And again, it's a very capital intensive business. We constantly need refreshing of capital and refreshing of our debt in order to fund, redevelopment and releasing efforts at our properties. And I think that's the biggest challenge we have now. I do think it'll come back. I think it'll come back to the quality operators, but until that comes back, it's going to be difficult.
Great. And I think, this last question here is a great question to end on. What is the one piece of advice that you would share with other people looking to invest in real estate or start their own real estate company?
Well, I think, I think for people looking to start their own real estate company, I had the benefit of being born into a family business. So I had incredible exposure. When I was in high school, I would work on the construction crews out building the malls. When I was in college, I would work on, in the summer, I'd work on development teams when we were, getting entitlements for new properties. So I was born into it. It's a tough business. It's a very tough business because you have to take a look at things in very long horizons. For us, a short-term decision is a 3 to 5 year decision. You have to take a look at things that have 5, 10, 15-year impacts on the health and value of your property. So I think, in terms of the second half of my answer, you need to be prepared for how long things take in commercial real estate development. Getting the entitlements, getting the deals put together with prospective tenants or venture partners, getting the capital raised, getting them built, getting them stabilized to a point where they cash flow. Some of these things can take decades, and it's very, very capital intensive. So you have to be prepared to ride out that capital need, and those periods where it's all capital outlay with very little coming in.
Great. Well, I appreciate it. So with that, we are almost near the top of the hour here. So I just want to take a moment before we wrap up to thank both Steve and Erin for joining us today. Thank you for sharing your career journey and all of your insights into the opportunities and challenges in real estate markets today. We appreciate both of you taking the time to be here with us today. I also want to thank all of our attendees for joining us. We hope you enjoyed the discussion. As I mentioned at the start of the session, we have recorded today's session, and the recording, as well as all of our other Finance Friday sessions, can be found on the Cutler Center website. So I encourage you to check those out if you have a chance. And I hope that everyone has a great afternoon.
Thank you. It was a pleasure to be here today.
Thank you so much.
Likewise. Thank you, Steve. Thank you, Leslie.
Okay. Bye-bye.
Bye.